Have you ever wondered what really makes our economy tick these days? We see incredible new apps, groundbreaking technologies, and innovative services popping up everywhere. But what's driving this modern world, and how is it fundamentally different from the past? That's exactly what economists Jonathan Haskel and Stian Westlake dive into in their insightful book, Capitalism Without Capital. It's a book that's fundamentally changing how we understand today's business world. For hundreds of years, when we talked about capitalism, we were talking about tangible capital. Think about it. Big factories, heavy machinery, vast warehouses, physical inventory, and piles of cash. This was the era of the industrial giants, where wealth was measured in physical assets that were rivalrous, meaning if one person used a machine, another couldn't at the same time, and often had diminishing returns. But Haskell and Westlake argue that we're increasingly living in a world dominated by intangible capital. What exactly is that? It's the stuff you can't easily touch or feel, like software, data, brands, and ideas. And these intangibles have four crucial characteristics, which the authors call the four S's, that make them incredibly powerful, yet also pose significant challenges. First, there's scalability. This is perhaps the most revolutionary aspect. Unlike a physical factory or a limited piece of land, an intangible asset like a piece of software or a new idea can be used over and over again by more and more people at virtually zero additional cost. This is often called non-rivalry, meaning my use of a software program doesn't prevent your use of it. Think of Google Search or Netflix. Whether 100 people or a billion people use them, the core software doesn't wear out or get consumed. This leads to what economists call increasing returns to scale, where the more you produce, the cheaper each unit becomes, and the profits can multiply exponentially. It also fuels powerful network effects, where the value of a product or service increases as more people use it, like social media platforms or online marketplaces. This allows superstar firms to emerge and grow incredibly fast. Next, we have Sunkenness. This refers to the fact that once you invest in an intangible asset, that investment is often very difficult to recover if things don't work out. If a traditional manufacturing company builds a factory and it fails, they can sell the building, the land, or the machinery to recoup some of their losses. But if a pharmaceutical company invests billions in research and development for a new drug that doesn't pass clinical trials, or a tech company pours millions into a software platform that no one wants, that money is effectively sunk. There's no physical asset to sell off, no tangible collateral. This makes financing intangible projects challenging for traditional lenders who prefer physical assets, and it means that intangible investments carry a much higher risk for the businesses making them. Third is spillovers. This characteristic means that intangible assets, particularly ideas, knowledge, and research, tend to spill over and benefit not just the company that created them, but the wider economy and society as a whole. Think about the development of the internet. While specific companies and governments invested heavily, the underlying protocols and technologies quickly became widely available, leading to the creation of countless new businesses, services, and opportunities, from e-commerce to remote work. The original innovators often cannot fully capture all the economic benefits that their innovations generate. This creates a positive externality, boosting overall economic productivity, but it also creates a dilemma for firms. How do you protect your intellectual property enough to incentivize innovation, while still allowing the beneficial spillovers that drive broader progress? Finally, there's synergies. Intangible assets often work best and create the most value when they are combined with other intangible assets. The value of a powerful algorithm multiplies when combined with vast amounts of data. The effectiveness of a brand is amplified by robust organizational knowledge and customer service software. Think about how a smartphone's value isn't just in its physical components, but in the seamless integration of its operating system, apps, and connectivity, all intangible. Innovation increasingly comes from combining different ideas, data sets, and knowledge in new ways. This leads to companies engaging in open innovation, collaborating with external partners, or acquiring other firms primarily for their intellectual property, recognizing that combining distinct intangible assets can unlock entirely new levels of value. These four characteristics create a fascinating, sometimes challenging, dilemma for businesses and policymakers. The scalability of intangibles means that if you succeed, the rewards can be enormous, leading to winner-take-all markets. But the sunkenness means that if you fail, your investment is mostly unrecoverable, creating a very high-risk, high-reward environment. While spillovers are incredibly beneficial for society by spreading knowledge, companies need to protect their intangible assets to maintain an incentive to innovate. Yet, too much protection can stifle the very synergies that drive even greater innovation. This inherent tension means that the modern economy often sees a widening productivity gap between leading companies that excel at leveraging these four S traits and those that struggle to adapt. These unique characteristics also complicate traditional economic models. It's tough to accurately measure the value of an intangible asset, complicating traditional accounting and national statistics. The benefits aren't always evenly distributed, leading to potential inequality as some firms and individuals thrive while others are left behind. And financing these innovative, yet sunk investments can be difficult for traditional financial institutions. So, what can we do? Haskel and Westlake argue that we need to adapt our systems to this new reality. Better data. We need to improve how we measure, track, and understand intangible investments at both the firm and national levels. Policy changes. Governments need to adapt regulations, tax systems, and intellectual property laws to reflect the unique nature of intangibles, balancing the need for innovation incentives with broad societal benefit. Investing in skills. Intangible capital thrives on creativity and critical thinking. So, education and lifelong learning become even more crucial to ensure people have the skills needed for an intangible-driven world that thrives on synergies. If energy revolutions like the steam engine and electricity drove the tangible capital-centric first and second industrial revolutions, then the information and intelligence revolutions, with the internet and AI at their core, are set to lead the intangible capital-driven third and fourth industrial revolutions. Crucially, artificial intelligence itself is not just a powerful intangible asset, but it also plays a vital role in the formation and amplification of other intangible capital. AI can analyze vast amounts of data, generate new ideas, and even connect disparate intangible assets to create enormous synergies. Therefore, we must view AI not merely as a technological advancement, but as a central force in the intangible economy. By embracing and guiding AI's potential, we can unlock unprecedented growth and foster a more innovative society. Ready to dive deeper into how intangible capital is reshaping our world and AI's central role in it? Pick up Capitalism Without Capital by Jonathan Haskel and Stian Westlake. It's truly a game changer. Thanks for watching. Don't forget to like this video and subscribe for more insights.